I'm Bob Repass, CEO of Revolve Capital. And as always, I am joined by our founder and CEO, Chaz Guinn. Chaz, how's it going today?
Good to see you again, Bob. March Madness, it's coming up, my friend. And I know you're a big gambler.
Well, March is one of my favorite times because we have March Madness basketball, but then we also have spring training baseball kicking off. So you know that's getting ready to come. So first we'll kind of tackle the March Madness real quick. For those of you that don't know, went to NC State, 1983.
Plug.
Jim Valvano.
Yep, little plug
right?
there.
That was my year. Unfortunately, we'll just say they're on the bubble, and that's probably a little bit exaggerated. I don't even know if they're on the bubble.
This could be the little sweetheart story, though.
There we go.
Well, here we go. Get your bets in.
So, having spent most of my high school and college days in North Carolina, ACC basketball was always my thing. My wife's family was big Carolina Tar Heel fans. I was a big NC State Wolfpack, and I guess my son, when he was growing up, didn't want to, stir the pot, so he decided to be a Duke Blue Devil fan.
What?
I'm not sure if it had anything to do with Coach K, Bobby Hurley, Christian Laettner, Grant Hill, and
maybe a little bit,
and that big run they had in the '90s. So, so the tournament time is always fun, and I'll fill out multiple brackets, see if I can, pick the winner. But I
feel like
now I'd have to say I like UConn to repeat.
There's always these, Xavier's, Villanovas, these sweetheart schools you never really are familiar with until they kind of storm onto the scene. I kind of like those stories. Yep. I find those are the hardest to pluck out when the brackets are as big as they are. But I think that's what kind of makes fun about. I hope college football someday can kind of get on to the same memo that I feel college basketball is in.
Absolutely.
Let a Liberty take down an Alabama.
There you go.
Let some small school get into the mix.
That's awesome. And then on spring training, I'm a lifelong Yankee fan. Although I do have a place in my heart for the Texas Rangers, where I say the
polar opposite, y'all.
The World Series champion Texas
and
Rangers.
We see you, Emilio. So we're really talking about the defending world champions, the Texas Rangers, baby.
But this spring training is a little bit different because, Chaz, you have your own spring training going on.
Oh my gosh!
Right?
Can't believe you brought that up.
Tell me a little bit about what spring training in T-ball looks like.
Oh, right, getting the eye black rolling. No, I'm so excited. I've got an almost 5-year-old and a 3-year-old. And because of they're about 18 months apart, they're on the same team for the first time this year. So you got to kind of see these little dudes not only play in the infield and then bat behind each other. As a dad, I'm kind of eating it up right now. So it's I've been able to see my oldest play a season or two, but now my youngest is coming along. So giddy up. It should be fun.
Yeah. Can't wait to
it's exciting times.
Awesome. All right, so let's talk about what's going on in the distressed debt space right now. What do you see coming across?
Me and you were chatting. We thought that COVID was going to break the dam in terms of how many delinquent assets were already being recorded on book from major loan desks, major aggregators of assets throughout the country, and yet here they were bailed out with a foreclosure moratorium, no evictions, no foreclosures, and 1 out of every 2 mortgages were being forbearanced. Right, so you started to see cans being kicked further and further down the field. So that being said, we've been kind of waiting for some of this distressed data to begin hitting the market. And then me and you have been exchanging a ton of articles where we're starting to see different outlets are now starting to report different foreclosure spikes. We're starting to see different markets like Nevada, like Michigan, like parts of Florida and Delaware. They're starting to have these increases in spikes where 1 out of every 2,200 homes are now facing foreclosure. We knew this writing was on the wall, Bob, and now it's like, oh, welcome to the table, welcome to the party that we're just now talking about that. Why don't you give kind of a different degree of context for somebody listening and saying, what do you mean foreclosures are spiking? What is now causing this inflation, shrinkation, all these semantics that we're starting to see in the market in terms of how are things being tamed? The job losses, we saw Apple cut 7,000 plus jobs. We're starting to see macro normal companies really beginning to slash employment out there, and some of those articles we'll be able to share here on the screen. But the whole point is, how do you see this kind of matriculating in the market and affecting potential investors that maybe want to get into the distressed foreclosure spike that we're starting to kind of read about.
Right. Well, I think you nailed it with a lot of the issues that the borrowers are facing now as far as being able to afford their homes and just the cost of living. And the support from the moratoriums and the COVID aid is, pretty much faded out. Now, there is some states that still have housing assistance funds out there that are willing to help borrowers stay in their homes. And I do think that's an untapped, market as far as borrowers being able to get there. Some of it is just awareness, and some of it is just the state's inability to process the borrower's paperwork in order to get that. Mm-hmm. We had the same thing back in 08, 09 with the hardest hit funds, right? They say history repeats itself.
Sure.
There was money set aside back then for the hardest hit funds to help borrowers stay in their homes, so they never got spent, right? There's been money now for 3 years sitting in the housing assistance funds that's not getting spent. Why? Exact same thing. Federal government gave the money down to the state level to disperse. Some states are much more advanced at doing that, and some just have a big, clog, right?
Have you, as a fund manager, even a portfolio manager, tapped into those funds historically yourself?
Absolutely. We were able. State of Kentucky's great.
Mm-hmm.
I mean, we had 2 full reinstatements, including back taxes,
mm-hmm.
and they were begging to send more Kentucky product, right? So various states are much more efficient at helping their borrowers stay in their home, right? Just think about it. You have a guy who's a year past due, hadn't made his payments, has 3 years back taxes, and we have the state of Kentucky bring that account current, pay the back taxes, and make the next 3 payments going forward.
And now bringing that account current for the investor listening, that means that's subsidies or dollars coming back to you.
Right, offsetting your cost your cost basis in that asset,
sure.
right? So if you bought that asset for $50,000, and all of a sudden you got an $18,000 check to reinstate it and bring everything current. And remember, you as the investor weren't the one who advanced those taxes.
Sure.
That was the previous owner of the loan, more than likely.
So now your $50,000 goes to a $32,000 cost basis, and now starting to make a profit over and above that 32 is kind of an easy game.
Absolutely.
Got it.
And in the future, we're going to go through an example of that on our upcoming episode where we're going to show how you can use a reinstatement like that to lower your cost basis.
Sure.
On an asset.
Now, I think that's kind of the different, and I think we kind of highlighted this at the beginning, whereas, we want to be able to provide you as the audience a first eye view and how we, guys that are actually in the business of managing an actual investment portfolio, backed by notes, backed by mortgages nationally. We have many different servicers that are in between, call it the delinquent homeowner and us as the investor, because we are compliant by RESPA to have that in between us. However, we are trying to kind of execute all different levels of exit strategies, and we want to bring you that insight and how we're doing it, how we're modeling it, and maybe you can be able to kind of steal a nugget or two on how that can kind of play into your business model. The foreclosure spikes that you've seen, what now are you starting to kind of smell, though, and the data you're starting to kind of read on the commercial side of things? We already know that the rate inflection, rates going from low 3s for how long? Cost of capital was nothing for how long? And now as the Fed begins its ramp over the last few years and then consistently going up 25, 50, 75 basis points, and now we're not seeing any cuts yet, right? So now we're starting to see the commercial space about to be hammered. So kind of share a little bit about what you've kind of seen on that side and how there's potential synergy between what happens in the commercial market and what happens for us in the residential market.
Yeah, we typically focus on residential, right? But you have to look at the whole macro picture because the real estate market in general, right? You have the commercial market, which will impact the residential, right? So case being, recent article came out. Now, this number is going to blow you away. All right, so I want you to pay attention to this. $929 billion with a B in outstanding commercial debt matures in 2024. Okay?
Now, what does mature mean? The loan's coming due, right? What does that mean?
That means that it was written with a balloon payment that came due, right? This is a 20% increase over the loans that matured in 2023. Which was already $729 billion, okay? So most commercial loans are written with a 3, 5, or 7-year balloon, okay? At that time, in theory, you owe that money, Okay? You have to pay that loan or you're in default. Historically, during low rate environments, that loan would get refinanced. Okay? You talked about historically low rates. Well, assets were trading at sub 5 cap rates. I mean, it was just crazy. There were syndicators putting deals together where they're going to do a value add, 3-year run on their apartment building, raise the rents, and refi out in 3 years and pay all their investors back. Well, that model was to refi out at 3 or 4%. Now it's 8, 9, 10, right? It's prime plus. Okay. So what's going to happen? Well, they're not going to be able to move on that liquidation piece. The part where people owe the banks, all right, what's going to happen when that loan comes due? Well, more than likely, the bank doesn't want to be the landlord. They don't want to own the property, right? So they can sell the asset, right, a distressed debt.
Mm-hmm.
Or they can refinance at a higher rate, but the cash flow and net income for the property is not going to produce enough to service the debt, right? Or they're going to tell the borrower, we'll refinance you, but you need to pay your loan. You can't pay the whole thing. You need to pay it down 20%.
Sure.
To get it down. Well, we're talking to, think about an office building in New York that matures. You're not writing a $10,000 check to pay your loan down. You're writing a multi-million-dollar check to lower your balance 20%.
So these guys either got to be sitting on cash or to be able to get refinance bailouts. They have to have some sort of solution from a loss mitigation effort to be able to bail out $929 billion that's set to mature.
I think you're going to see some banks move that product off their balance sheet.
Right. So to me, what I smell opportunity, right, as I'm starting to see a potential stagnation happen in an administration where now they're going to start and dip their toe into the commercial side to be able to pause and bail out some of these larger loans. But I don't know how you're going to do that, Bob. I mean, there's billions that are going to come due.
I don't think, based on the current status of the administration and what their play is, bailing out a corporate giant, someone who has $1 billion loan, I don't see that happening.
Me either.
Right? Corporate is bad, consumer is good, right? So you have to balance that messaging there. And that, we're talking about $1 billion worth of commercial property, but that downstream impacts the consumers, whether it's a loss of a job, whether it's an increase or a decrease in pay. It's just what happens when a building – look, what happens to some of those buildings during COVID that became vacant? And here we are 4 years later. A lot of them are still vacant, right? Some are being converted into apartments for affordable housing, but that's a whole nother capital raise.
Sure.
You can't just turn an office building into an apartment, right? I mean, that's a substantial capital
commitment. We are seeing
commitment.
mass conversions. I mean, even back in Southern California and Orange County, they've been having malls, right, that have been sitting vacant because the mall model is no longer really present anymore.
Right.
Everybody's shopping online. We're starting to see mass conversions of malls into apartment complexes and apartment buildings. I could see that happening, but how many people are going to be living in an office building that now is converted to an apartment that typically isn't built that way?
Right.
So sure, you're starting to see kind of a massive volume avalanche coming on the commercial side. We've been starting to see foreclosure spikes in different MSAs and counties throughout the country. Have you seen? I know we have. I just want to give your take a little bit. Is regarding the deal flow. How has that now begun to impact Revolve's deal flow? What are we seeing on the pricing desk in relation to some of these foreclosure spikes and some of this data that's starting to come out?
I would say if you look back 2-3 years and even prior to that, we would see pretty vanilla deal flow, right? It would be non-performing loan on single-family residence or it'd be a re-performing loan on single-family residence. It was pretty cookie-cutter product. Over the last 8, 9, 12 months, it started to pick up with a little bit of variety, right? Say a year ago, there's not much deal flow, inventory's down, right? We're sitting on all this capital, what can we deploy it in? All of a sudden, this new product, new to us as far as distressed debt, started coming to the marketplace. First thing we started seeing was HECMs, right, which is reverse mortgage. HECM is home equity conversion mortgage, where someone 55 or older was able to borrow against their house, get a lump sum of money, which was due upon death. The only loan ever created to default automatically.
Sure.
Right? They're all set to default. Well, all these loans were insured, by HUD. And now if the borrower is deceased, the property is vacant and secured, and there's no insurance claim that for HUD to pay, the investor can sell that asset. You are basically buying a REO property that you have to take to foreclosure. So you're buying paper, you're buying a non-performing loan.
But because of default, it's death. Is there anybody even to contest the foreclosure?
There could be. There could be heirs. It has to go through probate, right? But a waterfall of assets that we've talked about on previous episodes as far as loss mitigation, forbearance, modification, there's no borrower to deal with. Right?
That's why we like that product.
You may have a cash for keys if there's an heir living in the property, right? And instead of having to evict them, you can offer that. But you're going to get a piece of real estate back.
So it's less of a mortgage play, right, versus like your typical first lien NPL and RPL. And now you're dealing with a HECM on a defaulted asset because of due of death, right, that you now need to foreclose on to be able to get to the piece of real estate to eventually liquidate and cycle through.
So what do you build into your model? The key to that is the carrying cost, the timeline. How long is it going to take you from getting from point A when you buy it to point B when you get that property?
What's the timeline? So if foreclosure is typically active when you get these. Correct. So what's typically the timeline from the time you pick it up on foreclosure to the time you get to the auction?
Well, again, it depends if it's a judicial or non-judicial state. If probate's been settled, if there's anybody who can test it, it can be anywhere from less than 90 days to, again, 12 months.
Okay.
Right? Okay. So you just have to kind of build that into your model. And remember, there's no cash flow. So you're going to buy it at X, and you're going to keep paying X plus until you get to foreclosure, and then you cash out.
I get it. Yeah, but for any listener that's a construction, GC, fix and flipper, rental type of hold investor out there, this is the type of product you would focus in on. I'm trying to get to the real estate. I don't want to be stuck with the mortgage debt that now is beginning to cash flow, which I know many are bifurcated. A lot of folks that buy from us don't want the real estate. They only want the cash flow and the mailbox money to be coming into the investor that gets remitted to you monthly. However, if you're now talking about a HECM, right, now that's an additional real estate play that you kind of have a straightforward way to liquidate, right, get to the real estate.
Especially in today's market where the housing supply is so tight.
Where else are you getting product?
Investors are looking for product. And I'll add one thing, whether it's fix and flip, whether it's turned into a rental, you can also get that property REO, clean it up, and sell or finance it. And then you have a performing note. Right, so you're right back to the cash flow that you wanted in your portfolio, and then you go out and buy another one, and you have cash flow to offset some of your expenses.
And you still own the real estate.
And not only that, but you gave someone a chance to be a homeowner.
There you go.
Right?
Yep.
So there's a good play there, and we've seen a lot of that. We've bought some. We have some in our portfolio. It's still a learning curve as far as, tweaking our model.
Sure.
But that's what we do on an everyday basis anyway.
Okay.
Right? Because we take whatever regulations are put into effect, whether it's residential or whatever, and we tweak our model. Another product that's been very interesting coming across, I would say probably 18, 24 months ago, people were sitting in a lot of capital, didn't have inventory to buy, so they started making bridge loans, short-term hard money loans, whether it was to a rehabber doing a fix and flip, or whether it was just somebody doing a construction loan, or somebody just needed short-term funds.
Which we saw a boom from 2020 through now. Yeah, how many bridges and fix and flips were created during this housing craze when everybody was shuttered inside in 2020 and 2021, and everybody did this mass exodus out of California, out of the West, and started moving to Arizona and Idaho and Texas. What happened, though, when all these bridges and fix and flips stopped paying the lender?
Well, at that time when they took the loan out, the lender was putting his money out on the street at 13%, getting 2, 3, 4 points up front.
Yep.
Right? Okay, well, all of a sudden the cost of all the goods that these rehabbers are doing or their market changed because now all of a sudden they just rehabbed a $300,000 house, but because rates are higher and credit's tighter, they can't find enough buyers for their property. Guess what happens?
Here comes the bank. Here it comes.
Defaulted bridge loans.
Ooh.
Right?
New product type, first lien NPL, RPL, HECM, bridge. What else?
We're also seeing what we refer to as DSCR loans, right? Debt service coverage ratio. This is basically loans made on rental properties. Somebody had a rental property, right? Go back to the conversation we had a minute ago about commercial. We're written at a cap rate of 4 or 5%. Well, residential, let's say the cap rate was written at 8, right? So you have your rent, you got to subtract your property management, your taxes, your insurance, or whatever else, then you get your NOI. Well, all of a sudden that gets squeezed and you can't raise rent in today's environment because people can't afford it. So what happens? They get delinquent rental property loans
that are now pooled and being packaged and being sold and being liquidated in volume. So that's another product type that you're starting to see as fractionalized.
Yeah, we're seeing it because it's not like Chaz has one rental property.
Yeah, you got many.
Right? Chaz went out and bought 12.
Yep.
Okay?
Yep.
2 of his tenants aren't paying. 2 of them are. A couple of them are paying slow, right? Taxes went up. Talk about real estate being on fire. Well, what was one of the side effects of all the property values going up? Your tax value went up.
And insurance premiums kept going.
So your rent, that's a great point, especially in certain states, right? So if your rent hasn't been able to change, okay, even if your tenant's paying, if your rent you haven't been able to increase the rent, but taxes have gone up and insurance has gone up, what's that done to your net operating income?
Thank you. Squeeze
it, right? And all of a sudden you can't make a payment when, tenant gets behind. So you have 12 loans, 2 are paying good, the other ones aren't. All of a sudden you default on them. What does the lender do? So they want to wash their hands of it, get out of it, and sell those loans at a discount.
Now bring this to the surface. Are these now different product types that you've seen the firm diversify into that kind of complement and supplement kind of the criteria and focus of the first lien NPL and RPL already? You're just seeing these DSCRs, fix and flip, bridge as kind of augmentation products already to our core box, right?
Absolutely. And they give us the opportunity to maximize our yield, right? So we're able to give our capital partners and our capital investors, the yield that we're looking for in our fund because we're buying this on the DSCRs. Most of those are written at a high single digit, maybe 10%, okay? They're mostly LLC borrowers, right? They're not owner-occupied. So in a lot of cases, the foreclosures timelines are shorter than it would be if there was a homeowner in there, just because certain states, especially if the property is vacant, allow you to expedite that foreclosure process. So we're excited about the diversity that we see. We still like the vanilla stuff. Don't get me wrong.
Sure.
If I tell you, hey, Chaz, somebody just sent a trade desk, 25 non-performing loans, I want to take a look at it. We're all over it, right? But we also keep our eyes open for the new stuff. And I know the first time I was like, hey, take a look at this. You're like, whoa, yeah, what is that? We need to look at that.
So you've known that we've been pushing hard with the likes of HUD, the likes of Fannie and Freddie, and you've seen them kind of be consistent quarterly kind of sellers. And now we've seen kind of in the recent last few quarters, we've seen these community impact pools. There are these New Jersey, these New York, these Florida, these distressed markets that have a heavy concentration of delinquency. Typically 2.5 to 3.5 years is the average delinquency across these product sets. And you've seen that we've tried to kind of get at the forefront of being these community impact buyers. How have you kind of looked at a New Jersey type of pool, your home state, by the way, in relation to Cook County, Illinois pool? We talked a little bit about kind of the pricing metrics is when you're looking at and kind of factoring in where particular assets are in the foreclosure process. How have you seen over the last decade plus as the laws and foreclosure in the state of New Jersey, for example, differed from states like Illinois, states like Pennsylvania, et cetera? Walk us through a little bit about like your different nuances you've seen on those markets.
Well, one thing that we take into account, obviously, is the concentration issue because you're buying a whole portfolio in one particular MSA market. It could be Miami, it could be New Jersey, it could be Chicago, right? So you have to kind of balance that concentration issue. Do you really want 102 loans in one particular market, right? Even though Miami sounds sexy, having 102 properties in Miami may not be as good as having 102 properties throughout the state of New Jersey.
What's ironic is you'll come into an investor that wants to, let's just say, drive all of the doors in his portfolio. So now because something's local to him, he feels a little bit more warm and cozy because he can drive and go and see and put eyeballs on his real estate in his portfolio. Right. However, what happens when one market gets completely depressed, like Flint, like Detroit, and you have this massive wave of kind of destruction in a city or state. But however, your whole portfolio's in that location. Would you prefer diversification in terms of state location, or are you okay with kind of having pockets of real estate in one given city or location?
Yeah, well, historically, I'd much rather have diversification.
Sure.
However, I don't want to turn a blind eye to opportunity, right? So what is the opportunity on those assets as far as being able to get them, reperforming? Is there a certain percentage that you're going to be able to do and then take the other ones to REO? So it's just kind of blending on that. So we're interested. We're looking at those, and we're glad we got our foot in the door. But we're going to take it, step by step. Before we wrap up, over the years, I've been on a lot of panels. I've moderated a lot of panels. I've given a lot of talk. I always like to ask the panelists or the audience one question. Okay, so I'm going to ask you, but I'll be fair. I'll answer it myself too. All right, this is going to be hard for you, so pay attention.
Got you.
In one word, and I know one word is difficult, but in one word, what do you see as your biggest concern in the market today?
Awareness. Let me give that a little bit of context. Yes. We've seen the last 6 pools that we've acquired over the last 6 months, and we have seen a traditional next due payment, last payment made, however you want to coin it, roughly around 5.5 years. So that's pre-COVID, right? And we're just now seeing these assets beginning to get liquidated in the market. What has taken so long for you to properly mark that asset and move it to a liquidation standpoint? We call it AFS, available for sale. So what took you so long? What mark-to-market and modeling did you use to be able to finally identify that a sliver of your book that's been years delinquent and rotting has now just been moved to what we call the trade desk? So that being said, I don't know how much awareness a lot of these larger aggregators of product have amongst the sliver of assets, the thousands of loans that should be liquidated on book, and be able to free up that cash to be able to potentially solve some of those commercial issues or solve some of the affordability issues that we're seeing. But for me, I want to see how much awareness we have going into 24 and 25.
Awesome. Well, my one word you just kind of touched on right there, and I've kind of overused it throughout this conversation, and that is the word affordability. I think that is the number one issue, the number one concern we have, and it has been for the last couple of years, and every time I've been asked that question, that's been my answer. And the reason is some people will say rising interest rates, some will say unemployment, inflation, shrinkflation, whatever. But it all boils down to affordability, right? And affordability is not only housing, right? It's what else? Gas, food, electric. Can a borrower afford? Right? Can the borrower afford to stay in his house? Mm-hmm. That impacts us every day. Every decision we make on an asset comes down to, can the borrower afford to be in there, right? If so, we get them reperforming. So I think affordability is a big issue, right? So I like to focus on that. And guys, please subscribe, hit the like button, share with everybody. If you want to find out more about Revolve Capital and how you can be a passive or an active investor, you can email tradedesk@revolvecapital.com, or you can visit our website, revolvecapital.com.